Meantime, guys, does anyone have any questions from last week's session or any housing questions in general? Shanika and I would be happy to answer those while we wait for Dottie's tech issues to resolve. Just raise your hands or put them in the Q&A or in the chat, and we're more than happy to start answering. Okay. All right, so we got a hand raised. Stacy's on. Stacy was our guest last week. Good to see you, Stacy. Kia Edmondson.
Hey, did you get the info I sent you on?
I'm going to allow you to talk. Okay. Kia, you're live.
Oh, hi. Thank you guys for having us. Can you hear me?
Yep, loud and clear.
Okay, so I missed last week's meeting, so I was wondering if there are any great takeaways, just one or two takeaways that could really benefit me going into this meeting and just moving forward with home ownership in general.
Certainly. So good news is all our webinars are recorded, so anyone can view it at any time. Just check out the YouTube channel. It's Housing for All Camden. If you search it, it should come up. And if it doesn't, feel free to email Shanika or myself.
Oh, great. Okay.
So we're happy to get you. And we'll at the end of this session, an email should go out. Didn't work last week, but let's hope it works this week. That we'll have a link to our YouTube channel. So everything will be on there.
Thank you.
And we put all of the slides in Google Drive, and it's a link that anyone can access. So the slides from last week are up there too.
Okay, thank you for that.
So that's that. And then as far as big takeaways, so last week we had Stacy Pierce, who's with us this week, as a guest this time, or as a viewer this time. Last week she was a panelist. But she taught everyone about credit and the importance of credit. And so credit is kind of the bedrock of home ownership. And reason being, banks look at credit to extend you a mortgage. And how do you build credit? It takes time, and there's some tricks that Stacy did put us onto. I think a few of them were starting small, I think she said. She said you wanted to start with a prepaid card, or there's a few really good apps that she recommended to start building your credit if you don't have any. If you do have credit, you want to look at what's bringing down your score. Do you have a judgment? Is it because you're late paying your bills, and you want to look at the root of the problem? You want to get those taken care of. And actually, if Stacy's on, I can allow her to talk too. So I don't have to be teaching her my credit. Let's see if Stacy can speak. Stacy, are you there?
Yes, I'm here. Can you hear me?
Yeah, I'm sorry. Sorry if I butchered your credit teachings, but I'll let you have the floor for a little bit.
Okay, well, so I think some of the key takeaways from last week were inclusive of, but not limited to, the ideal of planning. So each dollar that you spend or that you save has a purpose, and starting wherever you're at. So you don't want to, get into the thinking that you don't have enough to save, because savings is also very important. So it's being credit worthy, but also being responsible with your dollars, and doing things like paying off your smaller debts, going into a reasonable and feasible relationship or arrangement with those creditors that you have a debt, especially if it's in collection, and addressing those.
Okay.
Having items on auto pay is also an immediate impact on your credit score. So though they're not necessarily tricks as ways to manage your funds, ways to look at your financial situation, your debt, your income, your savings, and have a work plan. And to me, it's taking a piece of paper, writing down your income, writing down your monthly expenses and your savings, what you can commit to save, and then those items that are on your credit report. And just be, you want to, take one bite at that elephant at a time. You don't want to look at eating the entire elephant at one sitting. And it's going to take time. For some folks, if you have a credit score of between 300 and 500, it took you a minute to kind of, take this in the spirit I'm saying it, kind of mess up your credit score, right? So it's going to take you a minute to get out of that. And if you've never had a history of savings, it's going to take you 7 tries to, build that savings and not tap into it, except for its intended purpose. So I think for me, some of the key takeaways were just very basic money management rules to live by, that anyone going through this process, no matter your income, your current living situation, can apply to their daily life.
Okay. Thank you for that.
So while we're waiting for Dottie to go on, I just wanted to do a quick introduction because I know some of you know me, some of you may not. Some of you may not know who On God is. I know that you've seen our names on the flyer. So I'm just going to introduce myself, and then I'm going to let On God introduce himself and tell you what he's done, what he's been doing in the city also. So my name is Shanika Boucher, and I'm the newly elected councilwoman for Ward 1 in Camden. We wanted to put this together just to make sure that people could have the information and take really small steps to figuring out how they can get into home ownership. And then if people were also looking to invest in properties, we were going to provide this series. It'll be an 8-week series, and each week we'll build on the last week so that, when you walk away, you'll be able to feel more confident about your ability to buy or invest in a house. And so On God and I partnered together to do this, and I'm just very happy to have him and to be working with him on this project. And we will continue to get it right. I know we've had a few technical difficulties, but this is the new world. So
we're hiring a CTO. Job title is open if everyone wants to join. Sorry,
anybody
Shanika,
wants to take on our technical difficulties. So we will definitely get it together, but I'm going to turn it over to On God to, so he can tell you guys a little bit about himself.
Sure. Thanks, Shanika. So my name is On God Guglani, and I'm the founder of Cooper Square Acquisitions. We're a real estate investment company and management company. We basically invest in properties, distressed real estate in the city of Camden, where we buy properties at. Oh, Dottie, you're live. Good. I'll shut up. Everyone, you guys can check us out online, and I'll let Dottie take the floor. Dottie, can you hear us?
Yes.
All right. Okay, so we're live. Can you see the screen?
Yeah, I can hear you. Can you hear me?
Yes. Can you see the screen, though? Yeah, we can hear you.
Hello, can you hear me?
Yep. We're good.
Okay, can you hear me now?
No. Yep, we're good.
Hello?
Yeah. That's not a good sign.
Hello?
We can hear you.
I can hear you. I can hear you, yeah, but I don't know if you guys can hear me. That's my problem.
We can hear you.
You can't hear me. Okay. Okay, so let me know when you're ready, and then I will go ahead and then.
We're ready. So we're live now. And Shanika, you ready to be unmuted?
Yes,
Okay. Dottie, can you see the screen?
Yes, I can see the screen.
So when you're ready to start, just start. And when you want me to change a slide, I can do that. Just say change slide or whatever.
I think I can manage the slides.
But the thing is that it's on my computer, so I'm the only one that can change the slides.
Oh, okay.
Yeah.
Okay.
So just whenever, just let me know. All right. So we'll start.
I'm ready whenever you're ready.
All right. And sorry again, guys. We promise next week we're gonna have Zoom figured out. We'll be experts by the end of the 8-week series, and we hope you're housing experts by the end of the 8-week series. That would be really our goal. But we'll let Dottie take the floor.
Okay. Good evening, everyone. My name is. Well, first of all, can you hear me?
They can hear you.
Can hear me. Okay.
Yeah.
My name is Dottie Sanders. I'm a loan officer with Fulton Mortgage. And what I do is I work particularly with first-time homebuyers. That's all I work with. And my responsibility is to help customers find a home, do the financing for them, and also help them with down payment assistance programs. So that's my position. I'm called a CRA loan officer. And the CRA loan officer means that Community Reinvestment Loan Officer. And so that person's primary role is to work with you to guide you from the beginning to the end. So when you come to me, I'm going to do the pre-qualification for you. I'm going to walk you through the process from the application all the way down to settlement when you get your key. Okay? So what we're going to do tonight is we're going to talk about the steps about home ownership, and we're going to talk about the do's and the don'ts. And during this presentation, if there's any questions, please feel free to stop me and ask me, because this is for you, and I want you to benefit from this conversation. Okay, so we're going to go into the first slide. So the first slide is owning versus renting. Now, when we talk about this, majority of customers are renting. And if you look at the amount you're paying for rent, and basically what you would be paying for your mortgage payment, normally you're paying 3 times more for rent than you would for your mortgage. And the reason for that is because the landlord has to make a profit. Okay, and so what you're doing is you're paying him, he's paying his mortgage, and he's walking away with the profit. The other reason that you want to own your home versus renting is when you rent a property, you cannot do or put yourself into your home. So which means you can't paint the colors you want. You may not be able to plant flowers on the outside. You may not be able to change your kitchen around, and that's because it's not yours. It's his. Okay, so he's going to control, that person's going to control everything about your property, and that's because you don't own it, he owns it. Okay, so that's what, these are reasons why you want to be sure that it's better for you to own than for you to rent. So let's go over that. It's a lower monthly payment. It's yours. You're going to own it after, let's say 15 or 30 years. It's yours, because right now, what any money you pay to the landlord, at the end of the year, there's no benefit other than the fact that you paid the landlord. Whereas if you own your property, you're building up equity in that property, so that if in the future you wanted to go back and get a loan on that property, you have equity, sweat equity into your property, and you can borrow against that. Okay, the next slide. Okay, how to fill out an application. Okay, so what happens when you call a person such as myself, which is a loan officer, we will do one or two things. Normally, I take the application over the phone, and if I have to send you an application, the application is pretty much self-sufficient. We're looking for specific information such as how long you lived at your address, how long you've been on your job. I'm looking for your income, and I'm looking for your assets. So those are the things that I'm looking for from the application. And the reason I'm looking for that is because I am looking for stability. When I ask you how long you've lived at your residence, I want to see that you're a stable person. So I'm looking for a 2-year rental history or a history at your residency. I'm looking for a 2-year employment history. And I'm also looking at how much money you have in your bank account. Okay? So when we're filling an application, these are things that I'm going to be concentrating on. Okay, now 90% of what I do is over the phone. So if you call me, I'm going to take the application because I want to make it as easy as possible for you because I don't want you stressing out over an application. No need for that, okay? Now, when I take the application, I'm going to ask you for specific information. That will be your W-2s for 2018 and 2019. I'm going to ask you for your pay stubs. I'm going to ask you for your bank account information. And again, as I said before, your residency information and your employment information, okay? Now, the reason I ask for W-2s and pay stubs is because I want to see what your income is annually, and that appears on your W-2s. Your pay stubs is going to tell me how much you earn either weekly, bi-weekly, or whatever method you're paid.
Next slide, Dottie.
Yeah, next slide. Okay. Now, the reasons for a pre-qualification letter. Okay. What happens is when you want to go out and look at a property, the realtor is going to ask you, have you sat down with a loan officer? And the reason they want to know that is because they want to know how much is your buying power. Realtors are self-employed, so when they go out, they want to make sure that they have a valid buyer. Okay, so when I do a pre-qualification for you, I'm going to be pulling your credit. Your credit report is going to tell me your credit scores. It's going to tell me how you pay your bills. It's going to tell me, it's going to show me how much you pay in debts, because your credit report will only pull up loans that you pay each and every month that report to the credit bureau. So it's not going to tell me how much you pay for the electric, how much you pay for gas, how much you pay for telephone. That information is not going to be there. The only thing that credit report is being reported by the creditor to the credit reporting agency. So that information I'm going to get from the credit report, and that's one of the tools I'm going to use to determine how much you can spend on a home. Now, really just to make sure that I've given you a issue. Qual letter tells the realtor how much you can afford to go out and shop for a home. But they're not taking you out and showing you homes above your price range. Doesn't make any sense. He wants to be sure that he or that person knows how much you can afford. And then they'll take you to areas that you feel you want to buy in, and to look for homes or price ranges in that area. Okay, so the next slide. Okay, income versus debt. Okay, now before we start on this, I want to explain something to the audience. When I, a loan officer, look at your income, I'm doing everything based on gross income. In some ways, that's an injustice to you, the customer, because you don't pay debts on gross incomes. You pay debts on net income. But yet, when I do a pre-qual, I'm doing it on gross income. So what I do, I take your monthly income and I times it by 43%. and that tells me how much you can spend each month on a mortgage. And then what I do is I look at your debts. And remember, these are debts on the credit report. So I add up your monthly expenses. Then I take that and deduct it from your monthly income. And that gives me an idea of how much a monthly payment you can afford for a mortgage. Okay? We normally like the debt ratio at 45%. Now, you probably heard Stacy tell you about income and debt ratios. I always ask my customers to do their homework. Their homework is to sit down and add up all the debts you have. And these are debts that I don't see. Now, the debts could be your food bill, your electric, your telephone, your gas bill, your automobile insurance, your babysitting money. All that should be added into your ratios. You need to calculate how much you spend each month for those expenses. Now, if you don't remember, pull out your checking account, and you'll probably find a lot of this on your checking account if you use a debit card. If you don't, then you need to pull out whatever receipt you have and add it up so you know how much you're spending now. Because when I give you pre-qual, it may be over what you're comfortable with, taking into consideration what you're currently spending or paying out for these bills that I have no knowledge about. Now, so when I look at a 45% debt ratio, that's based on your gross income. Okay, so I'm not looking at all the other expenses. So you may say to me, you know, Dottie, that's above what I can afford, because I've already determined I'm spending this much on these other bills. So we need to reevaluate what my monthly payment is. That's called you being a sophisticated buyer. That's called you being responsible for what I'm doing to make sure that I don't sell you a bill of goods that you're not going to be comfortable with. Because remember, my way of doing it is based on your gross income and only the debt that's showing on your credit report. So I ask you to please take time, add up all your debts, and make sure that what my payment is comfortable for you. Okay, on this slide, it also shows you the credit score requirements. Okay, credit scores went up. In March, because of the COVID epidemic, all lenders increased their credit score requirements. We used to have a 620 score. You can see how it raised to 660. And that's because lenders are experiencing a large portion of debts that's not being paid. Mortgage holders are not paying their mortgages. Automobiles are not being paid. Installment loans are not being paid. Visas and credit cards are not being paid. So the lender is the one who has the risk. So to make sure they have good qualified buyers, they've increased the credit scores to 660. Next slide.
Questions?
Already?
Everyone knows how to raise hands? Okay, great. Okay. Stephanie, we're going to make you live. Stephanie, you're on. Can you unmute?
Okay, I did unmute myself. Good afternoon. Awesome. I do have a question. This is my first time coming on. Is this housing program, is it similar to what, like the neighborhood, like the other programs that they have in the city, or no?
No, this isn't similar. What those neighborhood programs do within the city, a lot of times they are actually doing more counseling services with families. It's usually a lot more one-on-one. Some of
Mm-hmm.
the things that we're offering is a little bit similar in terms of information, but like neighborhood housing services, for instance, they basically help people get the grants that the city has to offer. So they
Okay.
really have like a little test for people to take at the end, but a lot of the information obviously will be the same about first-time home buyers and things that you'll need to do to qualify for loans. This was really an opportunity for the community to speak directly to experts,
Okay.
people who are doing it on a regular basis, like Dottie. Like she said, she is actually a loan officer. And
Mm-hmm.
a lot of times people will read something in a book that's very abstract, but when it comes down to speaking to a loan officer, they'll try to apply for a house and then they have to hear this information. So we wanted to give people an opportunity to learn it before they even, think about it. So what do you need to know before you even jump in to start thinking about the process of owning a home? And then the next few sessions will really be about people who want to invest. But yeah, what we're
Okay.
trying to do is a little bit different than those programs that already exist within the city.
Okay. I just asked because I do work at a mortgage company and I am in the midst of trying to purchase a home. So that's why when I saw about it, I just had some couple questions to see what it's all entail the next couple weeks. And that's why I just wanted to know.
Sure. Is there anything specific that we might be able to answer for you tonight in your
No,
journey?
I'm just listening right now, like kind of stuff I do have by me working at the mortgage company. So I've been there for 5 years. So I kind of know the ins and outs, but I just didn't know if it was like the same program like they have like for Parkside Business and Community. I just wanted to know the entities of the meetings going forward.
Yeah, and then next in the next few weeks, we'll be talking a lot more about investing because there are some people who are looking to like buy a home to live in, and there's some people who want to purchase homes to be able to rent out to other people. So we're going to get into that in the next few weeks.
Okay. Thank you
And,
so much.
and we do definitely recommend if you do have a local neighborhood like NHS or PCIB, definitely do go to those seminars and take part in those programs. Or just kind of like the training wheels to kind of get you there. So yeah, please do go.
Okay. Yeah, that's one of the questions I did have because I was kind of up in the air. I didn't know to go through one of the programs in the city or just go through my job of trying to see what's more feasible and by me being a first-time home buyer just as well.
I think I don't know what the exact regulations are. I can look them up for you, Stephanie, if you send me an email to
Okay.
find out, because like some of those programs, if you're going to get the grants, they require you to do specific ones or just making sure. I think that it's one that they recognize. The city right now, if you're moving into Camden City, I'm not sure where you're looking to buy a home, but they do have some grants. I think upward of anywhere $15,000 to $20,000 right now. And then
Okay.
sometimes they have places that they will recommend for you to go, or there's certain types of qualifications that they look for. So absolutely, if you send me that information, I can get you the correct information. So when you go forth, you can make sure that you also take advantage of some of those first-time home buyer grants that are available through the city.
Right. I definitely will. I do live in Fairview, and
Okay.
the house I am in, I'm thinking about buying it. So I want to be able to live here, but also be able to use it as an investment down the road.
Amazing. So we're happy to have you. Thank you.
Thank you so much.
Sure.
Okay, can I chime in for 1 minute?
Sure.
Of course.
So when we start talking about the city's program, I want to just bring you up to speed. The city changed the way they're giving they're allocating their income. I mean, their grants. They're only giving what you need. So it used to be $15,000. Now they're covering your down payment and they're covering your closing costs. So they've significantly reduced the payout. In most cases, it could be $5,000 to $6,000 because they're only covering, again, as I say, what you need and not a specific amount going forward. That changed as of January. There's also other grants that I want to bring into the conversation. Fulton Mortgage has what we call a matching contribution. That's 3 to 1. So for every dollar the customer brings in, they'll get $3 up to $5,000. So the way that works, The customer would have to put in $1,667. They get $3,333 for a total of $5,000. And that's above the City of Camden's grant. We also have Operation Hope. Operation Hope will give us a minimum of $1,000 and a maximum of $2,500. These funds are forgivable. They're not payable. You don't pay anything on them. They're just grants. So the customer benefits. So if they're buying in the City of Camden, they would get what they need for down payment and closing costs. And if there was a need for any additional money, we would then step in with these other additional grants.
That's great. So if everybody understands, all of that additional money you can add on top of whatever the city has to offer, whatever the bank has to offer, and then Project Hope. And then you can use all of that as free money, so that when you're going to buy your house, you can subtract that amount off your down payment, which is really great. That's a really great option to have. So again, Dottie might have to reach out to her. Obviously, she has a wealth of information. And there's a question in the chat. Dottie, this question is probably for you. The question is, what is the current interest rate?
Currently, it's 3.375.
So that also went up. That also went up this year then, because it was a little lower recently, hasn't it been?
Well, what's happening is rates fluctuate every day. And they're, of course, depending on the stock market. So when we start looking at first-time homebuyer programs, we try to control them to a very low rate because our programs are 3% down, no mortgage insurance. So it's a 30-year conventional mortgage, 3% down, no mortgage insurance, which allows for a lower payment. Now, the interest rate, I've seen the interest rate fluctuate between 3.25% and 3.375, and it's been pretty steady since March.
Dottie, could you explain how you're able to do it without PMI?
Yeah, no PMI, no mortgage insurance. So that is huge.
That's massive. Really, really big.
Massive. Yes.
How did you guys structure that? Is that through HUD or is that a unique program that you guys?
That is a program that Fulton Mortgage offers. That's our particular program.
So you guys should definitely check that out. I've never heard of anything like that. So really, really, really big savings. Because if you get a better rate, keep in mind you could be paying that rate for 30 years. It's a big savings if you multiply that over 30 years.
Majority of lenders today put customers into FHA mortgages. FHA is a very expensive mortgage. You're paying an upfront premium for their money, and you are paying a monthly mortgage insurance premium. Depending on the amount of your loan, you could be paying upwards of $50 to $100 more a month on that mortgage insurance. So if you're looking at a 30-year conventional with 3% down, FHA is 3.5%, and mortgage insurance. So if you do the math, you see that Fulton mortgage with 3%, no mortgage insurance is a win-win for you.
That's incredible. I mean, another reason why it's cheaper to own than rent, when we go to borrow, we borrow commercial mortgages, we pay 5.5%. So just off that, if you were buying the house, you'd have a lower monthly payment than renting, because as a landlord, we can't even get as close to cheap debt as you as a first-time home buyer can get. So really impressive stuff.
I think we see another hand up by Stephanie. Stephanie, do you have another question before we move on?
Okay, let me put.
I think I hit it by accident. I apologize.
Okay, no problem.
No worries.
Sorry.
Sure.
All right. Lower. Okay, guys, so we're going to move on to the next slide. Dottie, you with us? Hello? Dottie?
Looks like she might have dropped off.
That's not good. Okay. All right. Okay, so what can we do? Shanika, do you want to give her a ring? And in the meantime,
Yeah,
I
you
think
can ask
Stacy
more
is
questions.
dropping some knowledge bombs in the comments, so might as well put Stacy on for a little bit. Stacy, are you there?
Yes, I'm here.
Yeah, sorry. I think we're having some technical difficulties, but we're seeing what you're putting in the comment section. It's great. So, is anything you'd like to add?
Well, absolutely. So, as Dottie was speaking on the products for Fulton Mortgage, I also encourage that any first-time home buyer, like Dottie was saying, the greatest consumer is an educated consumer. So you always want to look to, doing your due diligence, at minimum 3 potential lenders. And there should be a checklist. And part of that checklist, you should be looking at what their first-time homebuyer products are, and things like your credit score, the length of employment, the length of housing, or what your residency was. We talked about municipalities and what they have to offer. You also want to look at your county level. You want to look at the county and see what they have available. Now, here's the thing. You can't bundle any and everything. So, like Dottie was touching on the different products that Fulton has along with Operation Hope, you can bundle those. Now, when you look at the county, and this is it's going to be a longer process than normal because of COVID. So you have to be patient. So this process is also going to test your patience. But anyway, so the county has money. So depending on where you're looking to live, you want to look at the county and make sure that, again, that you're able to bundle all of the products that every lending institution has, because sometimes you can't. There is a competition for second and third mortgages. But anyway, that's something, way beyond anything that you need to know, except that you need to see what they have to offer and if you're able to take benefit of multiple programs. Dottie brought up a great point. Looking at your gross income is what a lender is going to look at. But we all know that we don't work with our gross, we work with our net income. That's your income that you're bringing in after taxes and any other deductions, payroll deductions. And so even though you may be qualified for a $250,000 mortgage, that's based on your gross income. But realistically, based on your net, you may not be really capable of a mortgage more than maybe $200,000. So you want to be mindful of that. And so, again, the greatest consumer is an educated consumer. And so it's up to you to, do the background work and know that you should be able to trust your lender and your realtor and anyone else that's going to be in your circle during this first-time homebuyer process. And you need to be able to trust them and know that they have your best interest. And the best way to to make sure that happens is that you're prepared going into this. So another note that I had made was to know that at minimum $2,000 or more should be in your savings account at minimum. And again, 2 years on your job at minimum 2 years living where you're living. And so those are, you know, the very basics. Those are the three premises that a lender is going to begin to look at you as a potential customer for them.
So, Stacy, thank you so much for that. And I guess we may have lost Dottie. Maybe we had some technical issues, but I think what we should do is we continue on and go through the slides. And I think between you, Stacy, Shanika, and myself, we should be able to at least give everyone a good idea what's going on.
All right. Mm-hmm.
So this is right up your alley, Stacy. Do you want to talk about credit issues?
Sure. So there's a misnomer about bankruptcies. It depends on the lender. I am not an advocate of people filing for bankruptcy. Work out your credit issues and, you know, get a plan, make a plan and stick to it and address your debt. But as far as becoming a first-time home buyer, it is per lender. It depends on where you're going, to a retail bank, a mortgage house, a credit union. What they look at in terms of a bankruptcy and the impact on you securing a new loan, it just depends. So you have to check with them and see. They don't want to see a judgment. They want to see that that bankruptcy has been fulfilled, and that it's either being removed or in the process of being removed, but you should have documentation to that effect. Foreclosures. Again, anywhere from 3 to 7 years after a foreclosure has been addressed, a lender is not going to consider you as a capable loan recipient, for lack of a better term. So again, it just depends on who you go to. So anywhere from 3 to 7 years with the foreclosure on your credit report. Collections. Anytime you go into a relationship, not a relationship, but an arrangement to pay back a debt that's in collections, that is looked in a positive light, but you do want to pay down as much as possible before going to a lender with items that are in collections. And again, taking care of those items that are older and the smaller amounts will have a quicker and greater impact on your credit score. So I would address those first. But you should not really be going to a lender, even with items on collections or your student loan debt, which I wish Dottie was here to talk about. But you should not be approaching a lender until your credit score at this time is at least 660, because they're looking at your middle number. So Experian, Equifax, and TransUnion, those are your three major credit reporting agencies. Those are the ones that are legitimized by the lending community, right? So they're going to pull all three, and the vast majority of lenders are going to look at your middle number. So they're going to throw away the high and the low number. And so even before you approach a lender, you need to do, again, your due diligence and do your homework and make sure that your credit score makes you a competitive customer. And again, that being at minimum 660, which is the new average because of COVID.
All right.
So Dottie can hear us. For some reason, we can't hear her. So I don't know what's going on. So she'll continue to try to get on, and we can kind of just go through. If we can't get her back, we'll maybe ask her to come on next week and finish up before we jump into it. So we're hoping she's able to get back on, but we'll keep moving through.
Okay. So your credit score, again, it makes you competitive. So having obviously a 700 to 8, the perfect credit score of 850 lends you to a lender as the most desired customer, right? So again, a 660 will allow you to sit at the table and have a discussion with a potential lender when you're a home buyer or even looking to refinance. So it just gives you, your credit score gives you buying power. So the greater your score, the greater your buying power. And so it's just about being competitive. And so when you think about lending money to family members or friends, you're looking at their capacity to pay it back, right? And so a bank, a credit union, or a mortgage house is going to do the same thing. They're looking at the person that's going to be the most able to pay back that debt. And your credit score also looks at your ability to pay on time. I cannot stress enough to you all that paying on time. And for a mortgage house, they're going to look at you paying back your debt at minimum for a year. So if you've been paying your bills on time for 3 months, give it, another 9 months. You want to show them that I've had the ability for the last 365 days to pay my bills on time. So they're also looking at your payment history. So very important.
And it's important to do simple math. I mean, if you look at, let's say you have a $400 judgment on your credit, that'll really hit any sort of derogatory mark, like a judgment or a medical bill or something unpaid, that hits your credit really, really hard. So if you're going to sign up for a 30-year mortgage and your mortgage rate could be 0.5% lower on a $100,000 house, that itself is could be $500, right? And that's the first year. So it'd be much cheaper for you to pay off that judgment than it would be to have a lower score when you're going for a house, because that interest rate you're going to be paying for 30 years. I mean, a lot of people don't keep a mortgage for the whole 30 years, but still, it's a really, really big stream of payments. So it's important to work out your credit and kind of do a cost-benefit analysis, and that's what a credit expert like Stacy could advise you on.
And we have a question from Kaya.
Let's put him on.
He's on mute.
Kaya, you're live.
You have to unmute yourself, Kaya.
See it. Hello, can you guys hear me?
You're live.
Yes.
Oh, okay, good. I know that you guys mentioned student loans, and I just wanted to know how badly that impacts your history when you are, speaking with a lender. I'm sure it probably depends on your debt to income ratio, but are there other things that, will cause a hindrance when we discuss student loans and the amount that most students have to pay back these days?
So again, it's based on the lender. Now, normally it's about 1% of the total amount due. That's what they're looking at when they include that in your debt to ratio income. It's going to be 1% of the total debt, that student loan debt. Here's the thing. They're like the IRS. Any student loan debt, I'm talking about federal student loan debt. I'm not talking about private student loan debt, but any sort of federal grants that you received or any sort of federal loans that you received, they are the most forgiving, and they're the ones that are going to give you the most reasonable payback arrangements along with the IRS. Okay. So they may seem like the most aggressive or the most scary, but going into an arrangement with them and staying on point, again, for at least a year, to have an arrangement, no matter what that arrangement is, but that you paid it on time. And if at all possible, that it was on auto pay, it's going to have a significant impact on your credit score and the way that a lender looks at you.
Okay.
There's
Dottie.
looks like Dottie is back. She's just muted.
Okay. So am I muted? Hello?
No,
Dottie, you're
yeah,
live. Wow. Okay, we're back on track.
I had to go through some gyrations. Okay. So, thank you, Stacy. I was listening. Okay, so we're
You're
talking
welcome.
about the importance of assets, or did someone have a question on a previous topic?
The last question that came up was really about how lenders view student loan debt. That was the last question that came up. And I guess from a lender perspective, if you want to add anything on how are they viewing that student loan debt. I remember when I purchased my house about 12 years ago, they said to me that right before I purchased my house, they weren't counting student loan debt really, but now they're really counting it, and they're using it in the ratio to decide how much you can get in terms of a loan. So that was the question. I think that was really a concern.
So when I look at student loans, I ask my customers to apply for income-based repayment loans. Income-based repayment loans will set your payment at a reduced payment. So you could probably save upwards of $200, $300, $400 a month by asking the student loan provider to look at your income and assess a payment based on your income and not on their calculations. Because you may not be able to afford that payment. Normally when they do that, the payment is reduced, your buying power goes up. If you don't do that, what I have to do is I have to assess a 1% payment of the balance. And that's required because your payment is going to come due at some time during the mortgage. So we have to be sure that you can pay both your student loans and your new mortgage.
Thank you.
So the importance of assets, that's the next thing I'm looking at. Okay, so when I'm looking at assets, I'm looking to see, do you have enough money for your down payment, for your closing costs, and for your prepaid? Now there's 3 envelopes that when we start talking about closing costs. The first envelope is your down payment. So an example of, let's say you're spending $100,000 for a home. I'm asking you to put 3% down. That's $3,000. That's your first envelope. The second envelope is what we call prepaids. When you become a homeowner, you're responsible to pay the taxes. So what I have to do is at closing, I have to reserve that money to put into your savings account, so when your bills come due, I have money to pay them. That's your second envelope. Your third envelope is your closing costs. Closing costs are all title costs. Now, the majority of title companies charge you title based on the purchase price, not your loan amount. So title could be very, very expensive. A title company is responsible to run a 60-year search on the property. They'll also run a judgment search on both the buyers and the sellers. And the reason they do that is because the lender, wants to be sure that there's no encumbrances on the property. We want a clear title. We want you to have a clear title. The title company also responsible to record your mortgage, your deed, and your note. They're also responsible for the closing. They're also responsible to make sure you get a closing disclosure, which tells you how much money you need at closing. So when I'm looking at assets, I'm looking to see how much money you have, how much money you need, and how much money I have to help you get. Okay, and again, there are many, many ways to raise assets. You can get funds from your parents, that's called gift money. You can get funds from the county, which I believe I heard Stacy talk about. You can get money from the state of New Jersey. You can get money from grants. There are a lot of matching contributions out here, and if you're partaking in them, that's an excellent way to raise money. You can also take money from your 401ks, your retirement account, or your, I guess they call them pensions. You can get money from there. But when I'm looking at assets, the primary reason is to make sure you have enough money to go to closing. Okay, next.
Hey, Dottie, we do have an end time of about 8:30, so and we do have a few slides left, so if we're able to.
Okay, so I'll move this up. Okay, so the next slide is the New Jersey Mortgage and Finance. That is a grant through the state of New Jersey. The state of New Jersey will give you $10,000. Out of the $10,000, they will pick up the upfront down payment, and the remaining portion goes to closing costs. They record a mortgage on your property. It stays there for 8 years. There's a certain portion of that money that's forgiven each year. We've already spoke about Operation Hope, and we already spoke about matching contribution, which again, for every dollar you put up, the company will give you $3 up to $5,000. Next slide. Okay, closing costs and how we calculate. Okay, now we just went over the 3 envelopes. And the 3 envelopes were, number 1, the down payment. The second envelope was the prepaids. And the third envelope was closing costs. So when I look at, again, 3% down, you're going to give the realtor, if you want to make off on the house, $1,000. That $1,000 goes towards your 3%. So they'll bring that at closing, and you'll bring the difference. Okay, escrow accounts is monies we put aside, again, to pay your bills when they're due, and that would be your real estate taxes for each quarter. And as you make your payments, we take money out of your payment to cover your homeowner's insurance for this time next year. Okay, and again, title, we've already talked about the importance of title to get a clear deed to the property. Next slide. Questions?
All right.
Okay. Reasons for a home inspection. I always advocate for first-time home buyers to get an in-house inspection. An in-house inspection is going to tell you about that property. It's going to tell you the age of the roof, the age of the hot water tank. It's going to tell you if your electric is in good condition, your plumbing is in good condition. It's going to tell you if you have termites. So those are reasons that you definitely want to be sure that your home is in good condition. Because once you own it, it becomes your responsibility. You don't want to pay for someone else's problems. You don't want to inherit them. So if you get an in-house inspection, it's going to tell you the quality of the home. Majority of women look at homes and they're looking at the amenities the home offers. A beautiful kitchen, a beautiful bathroom, spacious bedrooms. Well, we're not going to go up in the attic to see if there's a problem in the attic. We're not going to go under the floor joints to make sure the floor joints are probably not going to look at the heater or the hot water tank. So that's what your in-house inspector does. You should, as a responsible buyer, please get an in-house inspection. Any questions? Next slide. Okay, how to manage real estate taxes when you're looking at a home. Okay. When you go out to look at homes, the first thing you want to make sure your realtor knows is that you're looking for a good house in your price range with low taxes. And what happens is in New Jersey, there's pockets. You could get a home or see a home in one area where the taxes are high. You could go 2 blocks and taxes are low. So you could still be in the same area, but because of the pockets for the taxes, those taxes could be high or low. Taxes have an impact on your monthly payment because the lower the taxes, the lower your mortgage payment. The higher the taxes, higher the mortgage payment. So the first thing you want to do is make sure that you're keeping an eye on those real estate taxes because they could either make your payment or they could hurt you. Any questions? Okay. The other thing, when you're out shopping, you can go on your computer and so you could go in, see homes, look at them, their interiors, look at their taxes. You can make a determination before you go in the car as to whether or not this is a house you want to go and see. Next slide.
Sorry, jumped the gun there a little bit.
First time owned a home in the last 3 years. So if you owned a home, let's say 5 years ago, you sold it, you haven't owned a home since then, you're now considered a first-time home buyer. The reason that you want to be a first-time home buyer is because you may be eligible for those grants that we've been speaking about to help you buy a home with very little money out of your pocket. Okay, so if you haven't owned a home in the last 3 years, you are now considered a first-time home buyer. What documents will be required? Okay, we are going to ask you for, now again, let me go back. Income comes in many ways. It could be Social Security income, it could be pension, it could be disability, it could be self-employment, it could be W-2. So once I take an application, depending on your source of income, I'm going to be asking you for documentation. So if you're a W-2 employee, I'm going to ask you for your W-2s from 2018 and 2019, your federal tax returns, 2018 and 2019. I'm going to ask you for 1 month current pay stubs and 2 month current bank statements. Okay, and that income is basically for me to verify the information you gave me verbally over the phone. So those are documents that if you're serious about buying a home, I ask you to go get your shoebox out, get those documents in that shoebox, so when you're ready to buy and the lender asks you for the docs, you don't have to go scurrying around trying to find those documents. Any questions? Next slide. Oh, okay. Well, I'm supposed to say thank you, guys.
Well, let's open it up for questions. Sorry, we rushed a little bit just to make sure we had enough time for the question and answer. So if anyone has any questions, please do raise your hand. We can add you on or put it in the comment section or Q&A.
I don't see a question, but I want to raise a question. So I guess my question is, if I'm thinking about purchasing a house, not yet at the first time home buyer. I know Stacy gave me a few good resources. She said that I should be comparing lenders. So once I do that comparison, if I'm really, really new to the process, how do I know what I'm looking at? Can you guys give me some tips on, like, I'm pulling comparisons, I'm trying to listen to all of the lenders and hear all of the products. How can I tell, which lender is going to be the right lender for me? How am I able to tell?
So,
Let's step in. When you're calling a lender, you want to ask the loan officer some specific questions. The first question is, how much is your down payment? How much is what is the rate? And you also want to know, what is the credit score requirement? And this is before you give the lender any credit application, because you don't want lenders to pull your credit. Sophisticated buyers do their homework over the phone and they don't give out any information. If the lender is hesitant to tell you how much is down, what the credit score requirement is, then they may not be the best lender for you, because this is information that should be freely obtained. Okay, so when you're looking for a lender, those are particular questions you want to find out. You also want to know about that mortgage insurance, because again, majority of lenders will put you in an FHA product, which, as I already mentioned to you, is not the best product for you. If they say to you, we have 30-year conventional and 3% down or 5% down and no mortgage insurance, that may be a good lender for you to look at.
Thank you. Any other questions before we close for tonight?
Well,
No.
there was one thing I wanted to talk about, and that's credit. I haven't heard anyone ask about credit. Normally when I have a first-time home buyer, the first thing people ask me about is credit. And the reason they're concerned is because, as has already been noted, credit can make or break you. Okay, when I'm looking at a credit report, I'm always looking to see if there's collections. If there's a collection on the report and it's going to stay there for 7 years, that could hurt you. That's a big impact on you. If there's judgments, that's a problem. So you want to look at your credit report and you want to see what's being reported against you. If there's judgments, you want to take the action to get them removed, to get them settled. If you have collections, you want to call the collector and try to settle for 50 cents on the dollar. Majority of creditors will do that, especially today. So if you owe $1,000, you could settle for $500. Depending on the number of collections you have, that could save you a lot of money. You want to do your homework with your credit before you apply for a mortgage.
Yeah, and I'm thank you for saying that. One of the things that I would like to add, in my experience when I purchased my home being very young, one of the things that I didn't know really was that I was the client. I was the customer. So I felt like I just was going to do anything. You know, when you want to get your first house, you're very anxious. So a lot of times, especially if you're young, you know, you go in and kind of just want to accept anything that they're going to give you. You don't really go in negotiating, but you do have a lot of power. So I just wanted to say that to people, because I know when you buy your house for the first time, you kind of just are anxious to buy the house. But I think that what Dottie said and Stacy said was really do your due diligence, because this is a long-term process and that interest over 30 years can really add up. And so the tips that they gave today, I think were excellent. Thank you. Thank you, ladies.
We do have one last question, if you don't mind, Dottie. Is that all right?
Okay.
All right. So we have, from Stephanie, what is the minimum to purchase the home through Fulton Bank? Maybe the minimum purchase price she's asking, a minimum down payment. I guess you answered the down payment, but maybe minimum purchase price.
I don't have a minimum. Now, majority of loan officers will not speak with a person unless they're spending 100,000 and above. And some of them want your purchasing power higher than that. I do mortgages as low as $50,000. I don't have a limit. The only thing that I do, I have to be careful because there's called fair lending. And if I do a mortgage below a certain amount, the title fees outrun the mortgage. That's where the problem comes in. But I've had customers come to me with a $60,000 mortgage because the other mortgage company would not touch them because they didn't want to be bothered with a $60,000 loan. So to be honest with you, I don't worry about the loan amount. I'm here for the customer.
That was good to know too, because that is true. If you can't find a bank that will take you because the house price is low, then right now, Fulton Mortgage, they will take you at that $50,000 threshold. Any last questions before we log off for On God or myself? Dottie put her email address in the chat. I put my email address in the chat. This is the second session. We have another session next Thursday at 7 p.m. We're going to start talking a little bit more about investing. And we definitely share everything that's up here on in our website, and you can go to our YouTube page and you can replay the videos in case something went too quickly. So if you didn't get all of the notes or if you missed something, you could always play it back and you could always look at the slides and watch the video. So we just wanted to let you guys know. On God, any final words?
No, once again, guys, really happy that everyone was able to attend. One promise from us to you is we'll get the technical difficulties sorted out by next weekend, we promise. And so next weekend, we're going to be having Eugene Alford of Sell All Properties. I believe they're the largest real estate brokerage in Camden, and Gene's a great friend. And he has, I think, almost over 35 years experience selling real estate in the city. So we're really excited for him. And if you guys have any questions, ask us, email anytime. And if you have anything else you'd like us to talk about too, feel free to make a suggestion. And I guess that's me signing off. Shanika, any last words?
No, that's it. Thank you guys for coming. We hope to see you again next week. Please feel free to let your friends and family know. And again, if people couldn't make it, we understand. And that's the reason why we do the playbacks and share the slides again on our website and then on our YouTube channel. And
big thank you to Dottie, and how could we forget Stacy as well? Thank you so much, Stacy. And on to next week, guys. Enjoy your weekend.
Thank you, ladies. You did great. It was excellent.
Good night, all.
Good night.
Night.